Good morning, ladies and gentlemen. My name is Greg Depsky, and with me is my colleague, Maureen Goffrin, and we thank you for tuning in today so we may provide you with insight on the Affordable Care Act, ACA as is known, and formerly also referred to as Obamacare, which is one of the most sweeping laws ever enacted. Our agenda today will quickly cover the general background, and then we'll get into the Affordable Care Act tax provisions, at which point I'll take a quick survey, and after that I will hand it over to my colleague Maureen, who will cover the Medicare and the investment income tax aspects of the ACA. In anticipation of today's webinar, President Obama gave a press conference stating that he supported legislation that would prevent policy terminations caused by Obamacare, which we've all heard about. This patch legislation should prevent terminations for at least a year. This situation is fluid because it's going to require legislation, of course, that has to pass through a Republican-held House, and also the insurance companies, which we'll find out in a little bit, which are a major part of Obamacare, the ACA, are also going to have to be able to somehow reinstate policies, which it's not certain they can do that. So this is something that really just has to be watched. His announcement is certainly a first start, but it's going to be a potentially long journey for the people who did get their terminations. If you have any questions, please email them all to me at gdepsky@spirecpa.com anytime during or after this webinar, and we'll try to answer as many of them as we can at the end of the presentation, given the time constraints. We're also going to post answers to the most common questions on our website, and we'll reply directly to your email with the specific answer to your unique questions. As we've all followed, the Affordable Care Act withstood a lot of trials on its way to becoming law, from congressional battles to a Supreme Court ruling, and finally to the presidential election in 2012. President Obama's re-election meant the law dodged its last outside bullet and will go into effect, although with possible scheduling changes, as we've already seen. We'll get into the various start dates later. The ACA is a very complex law that tries to reform a sector that accounts for nearly 1/5 of the American economy. It's approximately 1,000 pages, which is why there are many regulations that will need to be promulgated, and also why many people, including the executive branch and congressional members who voted for it, don't know exactly what the ramifications of it will be. The ACA does not replace private health insurance, nor does it replace Medicaid or Medicare, but instead attempts to make sure that every American has access to affordable health care. Without private insurance, the ACA could not exist. As just mentioned, two of the ACA's provisions enforce a cap on what insurance companies can charge in terms of a premium, and also provides for the removal of pre-existing condition clauses in which insurance companies were allowed to refuse coverage due to an existing health condition. The health insurance exchanges that we've heard about in the last several weeks are the mechanism to choose policies from online. When working, these exchanges theoretically allow for a fluid and seamless process to select insurance coverage. On March 31st of 2014, the individual mandate, amongst other provisions, will take effect. This means that anyone not having insurance after March 31st of 2014 will incur a penalty. The government is going to provide a tax credit on individual income tax returns so that people will only pay no more than a certain percentage of their income for insurance premiums. So, for example, an individual will only have to pay 2% of their income after the subsidy for their insurance, if they are in the 100 to 133% federal poverty line. So long as the employer coverage meets the minimum requirements of the ACA, there should be no change for people who get coverage through their employer. For those who have been watching the news, though, and hearing about people getting termination notices, realize that the new minimum requirements may be forcing employers to change their plans or even not to provide any coverage and pay the penalty, which has resulted in the terminations. That, of course, is resulted and culminated as recently as an hour ago in President Obama's press conference saying that he will support legislation to push off for 1 year the rules in Obamacare that are causing these terminations. To date, some of the more noteworthy provisions enacted are the grandfathered versus non-grandfathered plans, employers to provide 60-day advance notice of material modifications to existing policies, W-2 reporting for health coverage, which is employers who have 250 W-2s or more, dependent coverage to age 26, and no lifetime limits on benefits paid. Now we're going to cover some specific tax provisions of the ACA. The ACA requires large employers, which are, again, employers who have 250 W-2s or more, to report the cost of coverage under an employer-sponsored group health plan on an employee's Form W-2, which is the annual wage and tax statement. And this will be reported in Box 12 using code DD. But note that this amount does not affect any tax liability, as the value of the employer excludable contribution to health coverage, i.e. the premiums that the employer pays, continues to be excludable from employees' income and is not taxable. The ACA imposed a new fee on plan sponsors and issuers of individual and group policies. This is called the Patient-Centered Outcomes Research Institute fee, PCORI. As detailed by the IRS, this fee is to be paid by the issuer of fully insured group health plans, which is the insurer, and sponsors of applicable self-insured group health plans, which is the employer, including health reimbursement arrangements. The fee is paid via the IRS Form 720. The first year of the fee is $1 per employee covered life per year, and the second year fee is $2 per employee covered life per year, and then it's indexed to national health expenditures until it terminates in 2019. No fee is required on the HRA for participants' spouse or dependent children, so it's strictly for the number of employees. Starting in 2018, there's a high-cost insurance excise tax, which is applicable primarily to insurers who administer high-cost health plans, which are otherwise known as Cadillac plans. These are plans that have annual premiums in excess of $10,200 for a single person or $27,500 for a family. The insurer is subject to a non-deductible 40% excise tax in any month that the premiums exceed this threshold. The Small Business Health Care Tax Credit helps small businesses and small tax-exempt organizations afford the cost of covering their employees and is specifically targeted for those with low and moderate income workers. The credit is designed to encourage small employers to offer health insurance coverage for the first time or maintain coverage they already have. The credit varies over the years and will be available to eligible employers for 2 consecutive taxable years. And to be eligible for the credit, a small employer must cover at least 50% of the cost of single, not family health care coverage for each employee. The employer must also have fewer than 25 full-time equivalent employees whose average wages are less than $50,000 per year, as adjusted for inflation starting in 2014. And the qualified health plan must be offered through a Small Business Health Options Program marketplace, a SHOP marketplace is the acronym. . Now here's a fairly, I think, underreported aspect of the ACA. Beginning in January 1st of 2013, which of course is this year, people under age 65 can claim deductions, as they always could, for medical expenses on their Schedule A, itemized deduction schedule, for expenses not covered by their health insurance. But this year, it's for expenses that exceed 10% of their adjusted gross income, and not what was the prior 7.5%. For individuals age 65 and older and their spouses, the threshold remains at 7.5% of adjusted gross income until December 31st of 2016. Starting January 1st of 2017, all taxpayers may deduct only the amount of the total unreimbursed allowable medical care expenses for the year that exceeds 10% of your adjusted gross income. Starting in 2014, individuals and families can take a new premium tax credit to subsidize their health insurance coverage purchased through an affordable insurance exchange. The premium tax credit is refundable, so taxpayers who have little or no income tax liability can still benefit. The credit can also be paid in advance to a taxpayer's insurance company to help cover the cost of the premiums. There are several eligibility requirements to get the credit, but the primary two are that a person purchases coverage through the marketplace and have household income that falls within a certain range, which we'll see on the next slide. Any person who or household that earns less than 4 times the federal poverty line will qualify for insurance subsidies, which is the credit I just mentioned. So, for instance, an individual person who has income of less than $44,680, which is 4 times $11,170, which is the federal poverty line, will be eligible for credit. Starting on April 1st of 2014, the individual shared responsibility provision calls for each individual to either have minimum essential coverage for each month, qualify for an exemption, or make a payment when filing his or her federal income tax return. And this payment, of course, is basically the penalty for not having insurance. Note that while the ACA mandates people to have coverage by January 1st of 2014, the penalty only applies to non-coverage starting April 1st of 2014. And this is in large part because of the troubled rollout that Obamacare has had, specifically with the website glitches. The monthly penalty is the greater of 1/12 of a flat dollar amount or 1/12 of the excess income amount. The flat dollar amounts are $95 in 2014, $325 in 2015, $695 in 2016, and an indexed amount after 2016. The amount is cut in half for an individual under 18. The excess income amount is the excess of the taxpayer's household income over the taxpayer's filing threshold multiplied by a percentage. So for 2014, the percentage is going to be 1%. For 2015, it's 2%, and thereafter it's 2.5%. These are the filing thresholds, of which the income that I just mentioned will subtract these filing thresholds and then multiply by the percentages that I just mentioned. Let's run through an example just to show how the penalty works. Stan is a single 24-year-old tax filer who made $45,000 in 2015 and was uninsured all year. Although his employer offered health insurance costing $280 per month, Stan felt he couldn't afford such amounts, so he chose to go without insurance. Using the 2012 filing threshold amount of $97.50, here are the estimated calculations for Stan. First, in step 1, we're going to take his $45,000 of income, and we'll presume that that's all the income he has, and we subtract his filing threshold amount, which is $9,750 from the prior chart that we just showed. And that'll get us to $35,250, which is his excess income. Then in step 2, we take the percentage for that year, and in 2015 it is 2%, and we multiply the $35,250 by 2%, which gets us to $705. And then in step 3, we compare the minimum penalty for 2015 with the percentage of income penalty that we just calculated above in steps 1 and 2, and we take the larger of the two. Since $705 is more than the $325 standard penalty for 2015, Stan is going to have an extra penalty on page 2 of his 1040 of $705 for not having insurance in 2015. It's also starting now, actually in 2015, is the large employer mandate. Large employers starting 2015 must provide medical insurance or also be subject to the penalty the way the individuals are starting April 1st of 2014. A large employer is defined as one who has 50 or more full-time equivalent employees, and for full-time that means an average of 30 hours per week. And the employer can look back to prior year for the number of employees as a way of knowing whether or not they will be subject to the penalty, unless there's been obviously a drastic change in their workforce. But also a large employer, once they've met those tests, if they have, they also have to have at least one employee who is eligible for a premium assistance credit, and also an employer must not be offering an insurance plan, or if they are offering an insurance plan, it is either underfunded or too expensive for the employee to buy. For underfunded, it means that the employer pays less than 60% of the covered cost of the plan, which basically is the premiums, or the employee must pay greater than 9.5% of their income, and they decline to do so and decline to enroll in the plan. The IRS has issued a notice and some guidance on that, and says in order for an employer to determine whether or not an employee is paying greater than 9.5% of their income, they can look at the prior year W-2. Actually, they can look at the current year W-2, anticipated W-2, to determine whether or not it will exceed the 9.5%, and it's affordable. Regarding full-time equivalent employees, to determine those, what you do is you count up the number of hours that all employees worked. However, these hours cannot exceed 30 hours for any one employee. So if you have people who work 35 hours a week, you only count 30 hours and ignore the additional 5 or greater for those weeks. Then you take this amount, this total amount, and divide it by 1,560, which happens to be 52 weeks times 30 hours, which is considered a full-time equivalent employee week. And this will give you the full-time equivalent number of employees. If it's 50 or more, then the mandate applies and there's a potential penalty. The one qualification to that is that employers do not have to count people who work less than 3 months, which are considered basically seasonal workers. Regarding the non-deductible penalty, let's just go through it real quick. If there is no coverage offered, and at least there's one full-time person getting premium assistance credit, the penalty is going to be 1/12 of $2,000, or $167.67 per month for any month times the total number of employees for that month. The penalty is calculated based on the number of full-time employees over 30 hours, so there's the first 30 don't count. So for instance, let's say we have 70 employees, the employer would subtract 30, and then which would get them to 40, and then they would multiply it by the $167.67 per month to get a penalty of $6,706.80 per month. If the plan, though, however, is underfunded or too expensive, so the employer is offering a plan, the penalty is going to be equal to the number of full-time employees receiving a premium assistance tax credit, times 1/12 of $3,000, which is $250 for any month. However, this is limited to 1/12 of $2,000 per month times the total number of full-time employees. Amount paid as if there was no insurance provided. Again, this is calculated based on the number of employees over 30, so the first 30 do not count. One thing I want to point out here, and I think this is pretty important, this is a non-deductible penalty, which basically means that it's going to increase your effective tax rate. You don't get a deduction on your tax return. You don't get the benefit of the deduction when you pay the penalty. Thus, should you take the non-deductibility into account when you're doing an analysis of providing coverage or paying the penalty, you might find that it's very close to actually paying for insurance. And if you factor in non-economic factors, it might be worth getting the insurance. So just keep that in mind. Non-deductible penalties, unlike buying insurance and paying premiums, are not deductible on the tax returns. Let's go through a quick example to try to tie together everything I just said in that previous slide. For all of 2015, Widget Company, who is a large employer, offers health coverage to its 100 full-time employees. 30 full-time are eligible for premium tax credit and purchasing insurance on the exchange. The Widget Company pays only 40% of the cost of covered health services, which is 40% of the premiums. And as we recall, the employer has to pay at least 60%, so it does not provide the minimum value of the employer. For each employee getting the tax credit, the employer owes $3,000, or in total $90,000, which is $3,000 times the 30 people for the year. But as I said, the maximum penalty is capped at what it would have been had no coverage been offered. So we take the 100 employees in total minus the first 30 that don't count, and they multiply that by $2,000, and that's 70 times $2,000, which is $140,000 per year. The penalty is the lesser of the two, so therefore, since $90,000 is less than $140,000, this employer in particular in these facts are going to pay a $90,000 penalty for not providing, for providing underfunded insurance to their employees. Another change under the ACA is that health coverage for employees' children under age 27 is now generally tax-free to the employee. So given everything that we've just discussed, it's clear that an action plan of some sort would be needed, probably at all levels. Obviously, perhaps the larger the company, maybe the more extensive the action plan. So first, I would suggest that determine if your organization is a large employer. How many full-time employees do you have based on the government's definition of full-time employee equivalents? And will your part-time workers be considered full-time for this purpose? Again, keeping in mind that 30 hours is considered a full-time employment week. Then you want to determine if your coverage will be considered affordable, as well as minimum and essential. Once you've done that, you can determine if your organization is subject to the penalty, and if so, what is the extent of the penalties. Then, of course, you want to explore insurance solutions and whether to pay or play, whether you want to pay the penalty or you want to buy the insurance. And as I said, it should be kept in mind that the non-deductibility of these penalties could actually make purchasing insurance in certain situations more preferable. After that, you probably want to establish procedures to capture relevant data needed for reporting to government agencies. Regardless of whether you have a payroll company or not who are going to do quite a bit of the reporting, they still need to get the data from you. So you're going to have to capture the data internally and feed it to the payroll company so that they can report properly to the government. And there are quite a few reporting requirements that we haven't covered today, given time constraints. Then you probably want to follow certain administrative procedures, such as giving notice to their employees of the exchanges. This past October 1st, there was a requirement that all employers notify all employees of the existence of these insurance exchanges. Going forward, for any new employees that are brought on, there I think is somewhere up to a 14-day period where the new employee has to be also notified of such exchanges. At that point, you probably want to create also a team of advisors. Certainly you want to have people inside the organization, as I said, capturing the data and following this, as well as externally to assist you with reviewing both your organization's entire benefits and compensation strategy, as well as to help mitigate costs and improve efficiencies while remaining competitive in the marketplace. These next two slides are just basically a quick calendar of what's both happened this year as well as what's going to happen in the next couple of years. If you have any questions, feel free. We've covered some of these things, others we haven't covered. So if you want to email me and have any specific questions on any of these points, I'd be happy to answer them. At this point, what we're going to do basically is I'm just going to put out a polling question and allow you to answer. We'll give you about, I'd say, a minute or so just to answer it. It's not a quiz or a test, so it's not anything that you will be tested on any of the material that we had today. And if you just want to give us a quick answer. Okay, we're at about 80% who voted, so we're probably going to shut the poll down in about 15 seconds, I'd say. We're at 82%. So we'll shut it down in, yep, we're heading up to 90, so we'll shut it down in about 5, 4, 3, 2, 1. Okay. So for purposes just of the poll results, basically we had 24% yes, 68% no, and 7% were not sure. Just for your information. So at this point, we're going to move now to the Medicare and net investment income tax pieces of the ACA, which I will hand now over to my colleague, Maureen.
Thank you, Greg. That was very informative. I know that healthcare is a very hot topic for everyone at this time, so thank you for all that detailed information. Right now we're going to go into the Medicare tax and the net investment income tax, which are two new taxes that took effect on January 1st, 2013. There's an additional 0.9% Medicare tax on wages and self-employment income, and there's an additional 3.8% surtax on net investment income. And for the rest of the presentation, we will discuss what is considered net investment income and what's considered wages and self-employment income, and go through those and how the taxes will be applied to them. It's possible for a taxpayer to be subject to both taxes, but not necessarily on the same type of income. So the 0.9% Medicare tax will be levied on earned income, which is wages and net self-employment income, in excess of the following thresholds. And we'll go through examples to show you how these thresholds come into play. What are the effects on the employees? If you're a high-income employee, your employer must withhold the 0.9% tax on paychecks once your income reaches $200,000. If you are a self-employed individual, which means you file Schedule C or a partnership return, and you're a high-income self-employed person, you'll pay the 9% Medicare tax as part of your self-employment tax liability. If you pay quarterly estimates, you might want to consider increasing them to incorporate the 0.9% Medicare tax. In the past, your self-employed tax liability was eligible for a 50% deduction on page 1 of your tax return, and which will continue to be the same, but the additional 0.9% Medicare tax will not be eligible for that 50% deduction. The effect on estimated tax payment obligations, basically if you don't have enough withholding or estimated tax payments paid in, you may be subject to underestimation penalties. So you want to take a look at should you increase your quarterly estimates, or if you have a paycheck and get paid by your employer, you might want to consider changing your W-4 options to increase your withholding to cover these taxes. What are the employer responsibilities? The 0.9% Medicare tax only applies to employees, not the employers. So there's no matching required by the employer. But the employer must begin withholding the new Medicare tax once your wages exceed $200,000, regardless of the employee's filing status or income from other sources. I just want to point out that there are a couple other items that are included in income for this Medicare tax, such as taxable fringe benefits, group term life insurance in excess of $50,000, and third-party sick pay. So, for example, if you get personal use of your company auto added back to your W-2, and let's say that amounts $5,000, that will be subject to the 0.9% Medicare tax if your wages are over $200,000. Let's go through a couple examples to show you how this works. Bob and his wife file married filing joint, and in 2013 he earns a salary of $248,000. He has no other self-employment income or wages, and his wife has no other wages or self-employment income. Technically, Bob and his wife do not owe the 0.9% Medicare tax because they don't have wages or self-employment income in excess of the threshold for their filing status, which is $250,000. But Bob's employer must withhold the 0.9% tax on the excess over $200,000, which is on $48,000. The additional tax withholding is $432, which will be applied as a payment or additional withholding on the taxpayer's income tax return. In the second example, Amy and her husband file married filing joint, and in 2013 she earns a salary of $170,000 and her husband earns $160,000 for a combined adjusted gross income of $330,000. They have no other wages or self-employment income. There is no employer responsibility to withhold the 0.9% tax because neither Amy nor her husband have wages in excess of the $200,000. But they will owe the 0.9% tax on their tax return on $80,000, which is their adjusted gross income of $330,000 minus $250,000, which is the threshold for their filing status. So the additional tax that they would have to pay on this $80,000 is $720 in additional tax. So in each of these examples, the first example shows how you can have withholding on your wages but not be subject to the tax, and that's the first example. And the second example shows how you won't have withholding on your wages because you don't reach the threshold of $200,000, but you will be subject to the tax because of your filing status and your threshold level of $250,000. So let's talk about the second tax that comes into play, which is the net investment income tax. This tax is 3.8%, and it's levied on high-income taxpayers based on the lesser of the following two items. the individual's net investment income, or the excess of the individual's modified adjusted gross income over a threshold amount. And so for our purposes in this example, modified adjusted gross income includes foreign income and exclusions. But as we go through the examples in the rest of the slides, a modified adjusted gross income will equal adjusted gross income for our purposes. So in example 1, Tom and Gina filed married filing joint and together have income of $520,000, all of which is salary. The surtax will not apply because they don't have any net investment income. And I just want to point out as a side note, since we're talking about the 3.8% net investment income tax, and we just finished talking about the 0.9% Medicare tax, their wages will be subject to the 0.9% Medicare tax, but they won't be subject to any net investment income tax because all of their wages are salary. In the second example, Bob and Mary file married filing joint and together have $520,000 of salary and $60,000 of net investment income for a total adjusted gross income of $580,000. The surtax of 3.8% will apply to the $60,000 of net investment income calculated as follows. You take their total AGI of $580,000 minus the threshold amount for their filing status, which is $250,000, for a balance of $330,000. You compare this amount to the net investment income of $60,000 and take the lesser of the two, which is the $60,000. And their additional tax is over $2,000. So this can be a significant additional tax liability. We'll skip example 3 and we'll go to example 4. Jack and Jill filed married filing joint. They have salary of $240,000 and $120,000 of net investment income for a total of $360,000 of adjusted gross income. The surtax applies to $110,000 of income, which is calculated as follows. You take their adjusted gross income of $360,000 minus the threshold amount for their filing status, which is $250,000, for a balance of $110,000. You compare that to the $120,000 of net investment income and take the lesser of the two. So this is where you get to take the $110,000 versus the larger amount of the $120,000. So the surtax applies to $110,000, which is an additional tax of over $4,000. And you can read example 5 when you have time and when you want to enjoy reading about net investment income. The 3.8% surtax also applies to estates and trusts as well as individuals. So an estate or trust is subject to the 3.8% surtax to the extent of the lesser of the following two items: the estate or trust's undistributed net investment income, or the excess of the estate or trust's adjusted gross income over the dollar amount at which the highest tax bracket begins for the year. So in 2013, the highest tax bracket begins at $11,950, which is quite low. So let's go through 2 examples of a trust. Basically, example 1 will show you how we calculate net investment income and the related tax. And in example 2, we'll use the same figures, but we will give the beneficiary a distribution, and we can show you how there's some tax savings by issuing a distribution. So in example 1, ABC Trust may pay income and principal to its sole beneficiary, a single taxpayer who has no other income. In 2013, the trust has dividend and interest and dividend income of $170,000 and net capital gains of $290,000. The trust makes no distributions, and the adjusted gross income is $460,000. Because the highest tax bracket for a trust is $11,950, the net investment income that's subject to the 3.8% surtax is $448,050. The additional tax is over $17,000. It's pretty substantial. So let's use example number 2, and let's have the trust distribute $170,000 to its beneficiary. Therefore, ABC's trust's adjusted gross income is now $290,000 because it was originally $460,000. We made a distribution of $170,000, so for a balance of $290,000 that is now subject to the net investment income tax. So we'll take out the highest tax bracket of $11,950, and $278,050 is now the net investment income that's subject to the tax. The additional tax at this point is $10,000 for the trust. So by issuing a distribution, we went from a tax of over $17,000 to a tax of $10,000. But let's see what the tax now is to the beneficiary to see if in total there was a tax savings. The beneficiary was a single taxpayer, and their threshold for net investment income is $200,000. So the distribution to them of $170,000 of interest and dividends, assuming they have no other income, they meet the threshold where their $170,000 will not be taxed at all. Therefore, just by shifting some income from a trust to the individual, there was a tax savings of close to $6,500, which is pretty substantial. So there definitely should be some tax planning when you consider making distributions if you have the option in your trusts. I want to just point out that trusts, just like individuals, are subject to underestimation penalties. So when you are tax planning, you need to make sure you pay in enough money to avoid paying penalties to the government. Let's talk about what net investment income really is. It includes interest and dividends, like our examples. It also includes annuities, royalties, rents, and income from working capital. It also includes income and gains from S corporations, partnerships, sole proprietors, and sole proprietors if they are passive activities, which means you invest in them more than actively participate in them, which we'll go into a little further in the next couple slides. It includes net gains from the sale of property, including the sale of stock in an S corporation or an interest in a partnership. And it also includes income and gains from trading in financial instruments or commodities. Let's talk about what's not included in net investment income. I gave you a list of the most common items, so we can go through them. Salary, wages, bonuses, and self-employment is not included in net investment income, but just take note that it's subject to the 0.9% Medicare tax, so they seem to get you either way, either by net investment income or by the 0.9% Medicare tax. Distributions from IRAs, pensions, and qualified plans are not included in net investment income. If you have a gain on the sale of an active interest in a partnership or S corporation, interest from tax-exempt bonds, veterans benefits, Social Security benefits, and unemployment compensation. Although this is not an all-inclusive list, these are some of the other items that would not be included in net investment income. I want to point out that you're allowed to take investment expenses against your investment income, hence they call it net investment income. I want to point out that it's not a dollar-for-dollar calculation. Investment expenses are deductible as an itemized deduction only to the extent that they total more than 2% of the taxpayer's AGI, and also that your itemized deductions are subject to limitations based on income levels also. So it's not a dollar-for-dollar calculation, and but you are allowed to take investment expenses against your net investment income. Let's talk about how net investment income affects business entities. If a taxpayer owns an interest in an S corporation or a partnership, a sole proprietorship, or a single member LLC, any income or gain generated from the activity will not be subject to the net investment income tax if the following apply. The activity is engaged in an active trader business. The income is derived in the ordinary course of business, and the activity is not a passive activity to the taxpayer. So when you talk about an active trader business, it's something that you are actively involved in as opposed to an investor, but we can talk about the definition of active a little bit more in the next couple slides. The income is derived in the ordinary course of business, meaning what is your normal course of business, and if the income's derived during that, then it's not subject to net investment income, and I'll give you an example of what that means. And if it's not a passive activity, which is the opposite of the first one. So let's go into these a little bit more. Here's an example of an S corporation which is engaged in a non-passive trade or business. The determination of whether the income from the S corporation is subject to the net investment income tax is based on each taxpayer's or each shareholder's material participation in the trade or business. And we will define what material participation means in the next couple slides. If the corporation has two shareholders and the first shareholder materially participates in the business, his pro rata share of the income is not subject to the net investment income tax. If the second shareholder does not materially participate in the business, his pro rata share of the income will be subject to the net investment income tax. So if you take a business such as an auto mechanic business, and you have a shareholder who's underneath the cars fixing them, and he meets the material participation rules, which we'll go into, he will be considered as materially participating in the activity, and his portion of the income will not be subject to the net investment income tax. Whereas the second shareholder, he just kind of comes around, looks at the cars, doesn't really do much. He's considered as not materially participating in the business, and his share will be subject to the net investment income tax. I want to point out that if the business earned $10,000 of interest income, both shareholders would include the interest income as part of their, the $10,000 would be subject to the net investment income tax for both shareholders because it wasn't earned in the ordinary course of its trade or business, which is being an auto mechanic. We can take a look at a partnership that is engaged in a building rental. Rental activities do not constitute a trade or business by nature, and therefore they're considered passive activities. The income from this partnership is subject to the net investment income tax, but if one partner materially participates in the partnership, his share of the income would not be subject to the net investment income tax. But just keep in mind he is most likely subject to net self-employment tax, which is taxed at 15.3%, which is a lot higher than the 3.8% surtax. If there's no material participation, the income is subject to the net investment income. Again, as in the previous example, if the business earned $10,000 of interest income, both partners would include the interest income as part of their net investment income, and it would be subject to tax because it was not earned in the ordinary course of their business, which is being a rental business. Let's talk about what material participation means. I'm going to concentrate on the first three bullet points, but you can meet any one of the 7 following tests. If a taxpayer works more than 500 hours or more during the year in an activity, so if you work 40 hours a week, 52 weeks a year, that comes out to 2,080 hours. So if you work more than 50 hours, just to give you a gauge, it's about 1/4 of a normal work year. If you work more than 500 hours during the year in that activity, you would be considered materially participating in that activity, and the income would not be subject to the net investment income tax. Another test is the taxpayer does substantially all the work in the activity, including the work of the other partners or shareholders and non-owners. So you're comparing yourself to your workers as well. And if the taxpayer does substantially all the work in the activity, then you would be considered materially participating in the activity, and it would not be subject to the net investment income tax. If the taxpayer works more than 100 hours in the activity during the year, and no one else works more than the taxpayer, including the non-owners, then you would also be considered materially participating in the activity. I just want to go down to the last one, a general facts and circumstances test. Obviously, every situation is different, so you can look at each situation, individual facts and circumstances to see if material participation rules apply. When you are considering whether you materially participate in an activity, you might want to consider grouping like activities that are similar in nature. By grouping related businesses as a single activity, the taxpayer can meet the 500-hour test for material participation more easily. So let's talk about an example. If you have a business that has 570 hours and you have another similar related business that has only 60 hours, you would meet the test for material participation of 570 hours, but you wouldn't meet the test for you wouldn't be considered materially participating in the activity that only has 60 hours. But let's say the activity that has 60 hours is something that is either you're starting up or winding down, and it just doesn't require that much time anymore, or you're just getting it started and it's kind of a new business, so it just doesn't require a lot of time. You can actually group these two activities together for a total of 630 hours, and you would be considered materially participating in both businesses. You would actually do this by making an election on your tax return to group the two activities together. You would meet the material participation rules, treat the activity as non-passive versus passive, and it would not be subject to the net investment income tax. I want to point out that your businesses can cross over entity lines, meaning you can group a Schedule C business with an S corporation, or you can group a partnership with an S corporation or a C corporation. You can cross over lines. They just need to be similar in nature. Let's talk about rental income. Rental income is generally subject to the 3.8% tax, except if all the three following apply. The taxpayer is a real estate professional, and the income will be treated as non-passive. The rental activity is treated as a trade or business, and the taxpayer materially participates in the activity. And let's talk about what a real estate professional means and its definition. It means a taxpayer has more than one-half of his personal services performed are in the real property trade or business in which he materially participates, and a taxpayer who performs more than 750 hours of service during the year in a real property trade or business which he materially participates. So being a real estate professional has more stringent rules. You're talking about 750 hours versus 500 hours to just be materially participating, and you have to have more than one-half of your services in this area. So if you work 2,500 hours during the year, you have to have over 1,250 hours, because that has to be over half of your time in real property trade or business. So if you have a regular 9-to-5 job and you make a W-2 wage and you have a couple rental properties on the side, all that time is taken into consideration. So if you work the W-2 job and have 2,080 hours in one position, and then you have some rental properties on the side, you have to meet more than one-half of your personal time in this real estate area to be considered a real estate professional. And when we talk about real estate, real property trade or business, it means real property development, construction. It could be the acquisition of properties, conversion, rental, management, leasing, or brokerage. I just want to point out before we get into some tax planning strategies, it's probably important more so than before to look at your material participation hours and document them more closely. If you choose to take a position that you materially participate in an activity, you want to make sure you document your 500 hours or your 100 hours or whatever the requirements may be for that activity, because the IRS is going to be looking at this a little bit more closely now, because they have more at stake in terms of going after tax dollars for this, these two additional new taxes. So it's kind of crucial to take a position and back it up with documentation, which you were always supposed to do, but now they will be actually looking more towards this documentation to substantiate your tax positions. So let's talk about a couple tax planning strategies to either reduce your net investment income or your adjusted gross income to put you below the thresholds to help reduce these taxes, or possibly even eliminate them if you can. You'd want to consider investing in tax-exempt bonds to reduce your net investment income and your adjusted gross income. You'd also want to consider investing in growth stocks that don't pay dividends to reduce your net investment income, and it would also reduce your adjusted gross income. You may want to consider converting your IRAs to Roth IRAs. This will eliminate your required minimum distributions when you turn 70 and a half, and possibly reduce your adjusted gross income in the future due to tax-free withdrawals from your Roth IRA. You'd have to outweigh the tax implications of converting your Roth IRA now compared to deferring the tax to later on. So it'd be a little bit of an involved calculation, but it's something to consider. You'd want to consider whether distributions from a trust create any tax savings, which we showed you in the example with ABC Trust. You can consider deferring to apply for Social Security benefits to reduce your adjusted gross income, assuming they're still available to us at a future date. Determine if the taxpayer, for the entities, these three items you'd want to consider, determine if you materially participate in an activity. How many activities do you have? Do you want to consider grouping them so that you meet the material participation rules for all the activities that you have considered grouping? And to see whether you qualify as a real estate professional if you have rental properties, to see if you can be considered a real estate professional and meet the material participation rules there and not be subject to the net investment income tax. These are just some ideas to consider when you're talking about tax savings. Every person's individual tax situation is different, so you'd want to really look at your overall picture to do a comprehensive tax projection to see where you can reduce or eliminate some of these additional taxes that have been put in place. So Greg and I would like to thank you at this time for listening to our presentation. I want to do a quick poll and get your answers for this. Looks like about 50% of you have voted. A little bit more, which is good. Good to see you guys are paying attention. It always helps. As you're taking this poll, I just want to point out that this presentation is being recorded and will be up on our website for you to view at a later time, or if there are people who didn't get to see the whole thing or weren't able to register at all, it will be on our website also. We'll send an email out to let you know that it will be on our website when it's up and running. Also, if you want to email your questions to Greg at gdebski@spirecpa.com. After the poll closes, we'll take a couple minutes and answer some questions. So the actual answer to the poll is, what level of income does the 0.9% Medicare tax take effect? And it's $200,000. So at this time, we'll take a couple questions, and if we don't get to your questions, we will email them to you. I know we're getting close to wrapping up, and if you can stay on, we appreciate it. If you do have to leave due to time constraints, we understand. But like I said, if you email your questions and we don't answer them at this point, we will get back to you via email, and then our questions will also, with their answers, will be posted on our website. So I'm going to turn it over to Greg, who's going to answer a couple questions now. Thank you.
Okay, our first question is, in calculating the number of employees that should be covered by the plan, is there a differentiation between union and non-union employees? And generally speaking, no, there isn't a differentiation. A large employer is a large employer based on all the employees that he has. The unions, of course, will probably, the unionized employees will have quite often better benefits and health coverage, and that was part of the reason why, if you recall, the Cadillac plans and the 40% excise tax that goes on them starts only in 2018. The unions lobbied hard to push that off. So generally speaking, and I'll verify this, but the union and non-union are all counted as a large employer. Our next question is basically asks, you said that credits / subsidies are tied to income levels. What if I expect my income to change drastically during the year? Well, in that case, you pretty much need to stay on top of it. What you could do is you could choose to take part of the subsidy as a reduction in your premiums and delay the other part of it so it would be as a tax credit, which could be less if, in fact, you had more income than you expected. So just as Maureen had mentioned with the taxes that she covered, you have to stay on top of things. If you're certainly if you pay estimated taxes quarterly, you have to keep on top as to what your income will be, and certainly in this case also, if you expect to get credits, subsidies for premiums paid, you just have to make sure that you are eligible for them through the year, and if you have a spike in income, then you may not be, so you got to be prepared for that when you file your return. And our other question we have here is, please explain the non-deductibility of the penalty for individuals. I had mentioned that businesses, I mentioned in the business context that businesses cannot deduct the penalty for not having insurance on their business tax returns, and that's the same also for individuals. Individuals will, if they itemize, and that's certainly if they have other itemized deductions like mortgage interest and real estate taxes, they might be able to, under certain circumstances, deduct their medical, excess medical deductions, which, as we found out this year, is in excess of 10% of adjusted gross income. It's quite often it's tough to do, but it's far more easier to do than penalties, which are not deductible at all. So just like businesses, individuals should also keep in mind that when they make the decision not to have the insurance, they will get no deduction for that penalty that they pay, whereas if they do buy insurance, it's possible that they could get a deduction on their Schedule A itemized deduction for those insurance premiums that they pay. At this point, we're pretty much at the end of our time here, but I want to thank everyone for joining us today, and I hope that this certainly answered some of your questions and maybe created others. Maureen and I are available via email, as you can see. You can email me or Maureen, and we'll be happy to answer any of your questions, or if you want to call us, our phone numbers are up there. And thank you very much again, and we look forward to seeing you at our next webinar.
Thanks a lot. Take care.